Okay, shall we get started?
I think so. All right. Welcome, everyone. Thank you for joining us today for our tax strategy session. I'd like to thank Tal Binder, who's the CEO and co-founder of Gelt. Gelt is a modern tax platform for investors, founders, and business owners. And especially for someone like me, Gelt is my personal CPA as well, for the complexity that happens with Trifecta MD and telehealth and all of that. He has a background in finance and a very deep understanding of the tax challenges that high net worth individuals face. This is very much in alignment with Trifecta. Our goal is to make all women high net worth individuals. He's very passionate about making tax strategy accessible, personalized, and impactful. And Gelt is now redefining how people think about taxes. He knows that this is a compliance tax and it's a powerful tool for building and preserving wealth. So very nice to have you here, Tal. And then Tal, if you could also introduce Rachel and add anything else that you haven't. Actually, there's one thing I did not add. Tal's wife is a surgery resident right now, a plastics resident, so he knows what life is like for a physician and a surgeon. Rachel is a CPA with over a decade of expertise in public accounting. She specializes in guiding clients through the intricacies of tax laws and achieve optimal financial outcomes. So prior to joining Gelt in 2021, she had built her career on delivering tailored solutions to complex tax challenges with precision and care. She's motivated by a desire to bring exceptional tax services to a broader audience. And now she is creating personalized, efficient, and fully compliant tax strategies for clients. She's dedicated to empowering tax professionals through the integration of innovative, cutting-edge technology, ensuring they're equipped to deliver exceptional results. We are so excited for you to be here to share knowledge, and I will let you guys take it away.
Thank you so much. I really appreciate you inviting us, and it's good to see you. And now I wonder if you should go into sales, maybe, or we should try to hire in the company with those introduction skills. I will tell maybe just a bit of background of what led me to start Gelt, what we usually do, and how we got to work with physicians in general. I'm originally a tech guy, born and raised in Israel. Now I'm living in Florida. I sold my previous companies. I had a pretty terrible experience selling my previous companies, paid a lot of taxes in those transactions, and that's really what withdrew me to taxes overall and this US tax system specifically. Originally, we meant actually to work with mostly the high net worth individuals and the finance people like private equity, tech founders, and the corporations themselves. And over time, because as I saw my in-laws are also physicians, by the way. My mother-in-law, she is an anesthesiologist, and my father-in-law is a surgeon as well. And then as I saw and I got more acquainted with the US tax system and how it affects physicians and um, how little care and education is out there for them, because they also they don't have that much time to deal with that. That's the truth. That's how we actually started to move more and more also to accommodate with physicians, and that's how we opened really the more medical practice at Gelt and the taxes for the medical practices. And today we are working with physicians of all types, from like hospital W2 employees to locum tenens and private practice physicians and even surgical centers, full-on surgical centers. That the whole and that's something that has been very rewarding for the past couple of years. So that's important to keep in mind. So we completely understand the challenges that physicians are facing in their life, how much you are giving basically at work, and that at the end of the day you don't really have that much time to focus too much on taxes, and that's why you're looking up to professional to take that part of your life, and that's what we are going to talk about today. I think that specifically taxes are a very broad subject. You have many, many niches in taxes. We cannot cover everything of everything in this conversation, so we're going to focus. Our focus for this conversation is going to be on a couple of personas, specifically physician personas. Number one is going to be the W-2 employee physician that is working at the hospital, or even in a couple of hospitals, but the main source of income is W-2. The second one is the locum tenens physicians, that those are basically, usually you're jumping between multiple hospitals and receive your payments as like a 1099. And lastly, it's going to be the mixed income, the ones that are both W-2 and the locum tenens, and that your income is basically mixed between those two sources. Each one of them is going to have their own like unique scenarios, um, their own unique characteristics, and what you can and what you cannot do, and what makes more sense and less sense of doing. Of course, what we are going to share with you is not like a personalized tax advice, but we are going to share it in a case study format. Basically, we are going to take each one of those scenarios and break down what potentially can be done for those people. We would be happy to answer any questions, and if you have any specific requests or questions throughout the call, just post it on the chat, and we'll basically address that as we go. But saying all of that, I'll pass the microphone actually to Rachel to take it from here.
Okay. Like Tal said, we want to go through some different case studies and really focus on how through tax planning and strategies, we can help people achieve their goals. It's really important as you make more money, you're paying more in tax, and it's so often that because taxes are scary or because you don't understand, that you really miss opportunities where you can do certain things that'll help you achieve your financial goals and also minimize your taxes. So when we're building a tax strategy plan for someone, we really want to focus on what's important to them, and how we can leverage that to help them achieve their financial goals and ultimately build wealth. So what that process looks like, the tax strategy that's relevant for someone is very specific to the person, but we tend to go through the same to identify what plan is going to be optimal for someone's tax situation. We always start with looking at the structure of what they have going on. So that's going to be, if you're a W-2, are you married? Do you have real estate? We want to understand your entire tax picture so we can identify the points where different entities or different income streams relate to each other, and there can be opportunities. So we always start with just understanding your structure and identifying opportunities there. Then we want to look at if there are any losses or deductions that we can take advantage of. That involves looking at your prior year tax returns, seeing if if you're holding any assets that are at a loss, or if you have any loss carry forwards that you could potentially leverage in future years. From there, we'll move on to, if you do have a business, making sure that you're optimizing your business expenses. That can involve looking at your home office, vehicle, seeing what expenses you're deducting and making sure that you're taking advantage of everything there. We'll look at your, current investments and what tax advantage investments might be available to you. This is a really important step, and this is where your personal preferences really come into play. So for someone who's interested in real estate, there are tons of opportunities with real estate investment, some of which we'll talk about today, available to you. But with most things, if it sounds too good to be true, it probably is. So we really focus on a holistic approach and making sure that we're making recommendations that are going to be things that you're originally interested in. So if you're not interested in real estate, trying to become a landlord to 6 different properties is probably not going to be something that you find joy in. It could be frustrating for you, a lot of work, and ultimately you might be saving taxes, but it could negatively impact your life. So we always want to find that balance between, optimizing your taxes and doing things that you're passionate about or interested in. We always like to focus on retirement contributions. This also can be highly personal. Some people prefer to invest in real estate and use that as their retirement plan. But if you're interested in contributing to tax deferred retirement plans or retirement plans with tax-free growth, we'll always explore ways to help you maximize that outcome. And then charitable giving and any other credits and deductions that might be available to you. Again, it depends on your situation and what you're interested in, but we'll go through and see what opportunities might be available to you and make some recommendations. So this general process is something that we will go through with all of our tax strategy clients. And as you'll see, the outcome of it is different for each individual person. So let's get into our first case study. So here we have a W-2 physician.
Just 1 second before we get started. When we say, by the way, a structure, your entity structure is really what it means, how the money flows. Like to which, is it going to a company? Is it going to you personally? If it's a company, is it an LLC? Is it a corporation? What type of LLC and corporation? Through which legal entities are in place and how the money flows in between those legal entities. That's sometimes we know that it's a bit confusing if you're not really deep in that area.
Exactly. So our first case study, we have a W-2 employee. They're working at a hospital, living in a high tax state. They don't have any entities. It's just themselves earning income. They aren't taking very many deductions. And a primary challenge that we have here is because they have W-2 income, sometimes there aren't that many, levers or opportunities available to take those major deductions. So we really have to get creative with the tax strategies that we employ here. Something that we'll often, want to find out is if people are interested in giving. If they are, there are great opportunities with donor advised funds and stacking your charitable contributions. We always want to look at retirement plans, maximizing retirement from a deferred tax perspective, where you're saving money now by contributing to retirement. And then also thinking about, do you want to put additional money into retirement through a Roth, where you're not getting a benefit now, but that income can grow tax-free and you won't pay tax when you take it out in retirement. So the W-2 is always a fun challenge, because we really do have to get creative in finding tax opportunities. So in this case, we focused on maximizing retirement savings, contributing to donor advised funds, and tax loss harvesting for their investments. I'm going to move on to what the outcome looked like, and then we can talk about how each of these things affected their tax situation. Oh, and I see the question, there's no maximum that you can invest in a donor advised fund. A donor advised fund is actually really cool. If you're familiar with tax loss harvesting, which is where you sell something at a loss to offset your capital gains and reduce your income, contributing to a donor advised fund is like reverse tax loss harvesting. So you would take appreciated stock and contribute that to a donor advised fund. And what happens is, instead of, if you had just sold that stock and contributed the cash to a then you would have a capital gain that you would pay tax on. If you contribute that stock, you don't pay any tax on the capital gain. You get a charitable deduction for the value that you contributed. So you save on the gain and you get a deduction. So you can contribute as much as you want, up to 30% of your total income. And then you also get to choose when you contribute that, when you pass that money on to a charity. So if you had Apple stock that you contributed 3 years ago, that stock can continue to grow tax-free. And then if it grew from 10,000 to 30,000, then you'd have $30,000 available to contribute to a charity of your choice. So for someone that's interested in giving and has appreciated stock or other assets, the donor advised fund is a really cool tool. Getting a little more into this example, we have their W-2 income. With W-2 income, it's really limited on what we can do in terms of directly offsetting that. The opportunity that we had available in this case was we could increase their retirement contributions. So they weren't maximizing their contributions. They're only contributing about $5,000 a year. We increased that contribution to $23,500 for the year, which reduced their taxable wages. With their capital gains, they did have capital gains, but they were holding stock that had gone down in value. So they leveraged tax loss harvesting, which means that they sold their stock that had gone down in value, and then that loss was able to offset their gains that they would have been taxed on anyway. So you can offset up to all of your gains that you've realized by selling things at a loss, plus an extra $3,000 that can offset your W-2 income. This person was also interested in short-term rentals and real estate. Before we met them, they had one rental property. It was a long-term rental, and so what was happening is because rentals are generally considered passive income, the rental property was generating losses each year, but they weren't able to recognize the losses on their tax return. So by investing in short-term rental properties, which are by definition held for rent for less than an average of 7, like the average rental period is less than 7 days, and actively participating in that rental activity, they were able to take all of their rental deductions as an ordinary loss and offset their W-2 income.
Rachel, maybe that's a good place to stop for a second and expand a little bit more about short-term rentals in general. That's one of the few ways that it can very, very positively affect W-2 taxpayers, that's their main source of income. You don't have a lot of options. Short-term rental is one of the very few areas that, as you can see in this table, like the deduction is pretty large. Saying all of that, and it is something that is a bit more complicated to implement. Even with all the tax savings, it's not best for anybody. Like, it means that you need to start managing a rental property. Some people feel very comfortable and feel very happy owning and renting a property, but it's not for everybody. It takes time. You have tenants, you need to manage the tenants, you need to bring new tenants in, like renewals, all of these kind of stuff. So it's something that definitely, while it presents a lot of upside from a tax perspective, sometimes if it makes your life miserable, you should not do that. Taxes will always be the cherry on top of your tax planning of your planning in general, or the financial plan. It should never you should never fully change your life unless it's really worth it for you. So short-term rental, just be careful there. Number one, with all the definitions, because there are a lot. What Rachel mentioned is really the
Scratching the surface.
it's just like the long story short about that. But it's a more complicated one. Definitely consult a professional before implementing it, and make sure that you actually like it. You actually like doing that before you start to to have a large financial commitment for the rental itself. And I'll pass it back to you, Rachel.
Yeah. So the last thing that we did for this client is under total deductions, that represents the donor advised fund contribution. So they had purchased some stock that they bought for very little. It had grown to about $23,000. And so by contributing that stock, they got a $23,000 charitable deduction. And then they also didn't have to pay tax on any of the capital gains from that they had from owning that stock. So all of that amounted to total savings in year one of about $40,000, which is great considering, you know, W-2 income. A lot of times your opportunities can feel really limited. You don't get to have those business deductions unless you live in certain states. So we were really excited about this outcome. And then move on to number 2. So in this example, we had a client that was earning all of their income on a 1099. So they were doing contract-based work at multiple facilities. They're getting paid personally for all of their income. So they had a lot of money coming in, but they didn't really know what to do with it. They weren't really doing any planning, not thinking about taxes until tax time. And then they were just paying tax on essentially all of the income that they were making. They didn't really have time to focus on their deductions. And so they you know, they were taking the path of least resistance and just paying tax on everything. So again, we started with the entity structure here. We recommended that they open a PLLC, which they could then elect to be taxed as an S corporation so that they didn't have to pay self-employment tax on all of their income. Getting into the benefits of an S corporation is a whole other discussion, but it is an opportunity to save. It's definitely an opportunity to save a lot in tax. You typically pay, you know, income tax on all of your earnings. And if you're self-employed, you also pay payroll tax, which is Social Security and Medicare. If you elect to be taxed as an S corporation, you're still paying income tax on all of your income, but you're only paying that self-employment tax on the amount that you pay yourself as salary, which can be less than your total income. So you're still able to take the same amount out of your business between payroll and distributions, but the ultimate result is that you pay much less in tax. For this client, we also set up a 401k retirement plan to help them contribute more to their retirement. And we took a deep dive into their business expenses and helped them understand what they can deduct and optimize their deductions against their business income, because that was a big missed opportunity for them. So in this example, you'll see they started out without any W-2 income because they were earning everything as self-employment income. And then after we applied the tax strategies, they did pay themselves some salary. And ultimately, what they paid as business income was reduced drastically. Part of that is the salary that they pay themselves is a deduction for their business. And then on top of that, we were able to take a home office. We helped them deduct their continuing education, licensing, their mixed use expenses. When you're running a business and you're getting paid as a 1099 and it's just you, sometimes it's hard to think of money that you're spending as a business expense. But if you think about it, like, you are your business. So anything that you're spending money on that helps you run your business better and helps you be better at your job is potentially a business expense. If you listen to music while you're at work, then your headphones could potentially be a business expense. So really, really thinking outside the box in terms of what can be deductible for against your business income is really important. We helped them implement a solo 401k and maximize their employee contribution and also make a profit sharing contribution. Part of that contribution is also deductible by the company. And then they were also interested in charitable giving. So we had the donor advised fund in this situation as well. So total tax savings, we ended up saving $62,000 in year one. And then overall, they were able to, a lot of that they were able to contribute to their retirement, and ultimately keep more of the money that they're earning. Then going into our third use case, now we have a situation where we have mixed expenses. We have W-2 income and some income earned on 1099. So this person was interested in real estate. They did already have a PLLC set up that they were earning income through. And overall, they weren't sure, what should they do with their tax situation. A lot of people, read online about S corporations. They came to us thinking that they definitely needed an S corporation. And also they were missing a lot of deductions against their 1099 income. So for this person, we did run an S election analysis, and we helped them optimize their business expenses. And this is where it's important to emphasize that not every strategy is going to be right for everyone. In this case, where in the example that we just had, the S corporation helped them save a lot of money. In this case, the S corporation wouldn't be worth it. Having an S corporation costs money. You have to file another tax return. You have to give yourself payroll. There's definitely more compliance involved there. And it's not always worth it. If they were going to save, $8,000 in tax, but it was going to cost them $8,000 in compliance costs and headache, then that's not something that we want to recommend. We always want to make sure that the benefit of what you're going to do is going to outweigh the cost. So that was something that we ended up passing on in this situation. Again, they were interested in real estate, so the short-term rental and cost segregation study was really exciting for them. And they were able to invest in more short-term rentals. And then they're also interested in the charitable giving, donor advised funds. So in this example, their W-2 income stayed the same. Their business income, we were able to optimize their business expenses. So we were able to bring that business income down. Because their W-2 income was so high, their business income isn't subject to the same amount of self-employment tax as say the first example was. Because they've already reached the Social Security limit, they're only paying Medicare on the tax. And that's also something that impacts the decision of whether or not an S corporation is going to be beneficial. So we kept them as a self-employed business. We helped them maximize their retirement contributions, have the short-term rental loophole, and then overall we saved about $45,000 for this customer. Okay. So now that we've gone through all three examples, we're going to kind of take a step back and look at them holistically. And as you can see in each example, even though they did have similarities in what they were interested in, we didn't end up with the same outcome for every person. They all were making about $500,000. They were all working in the same field, but they didn't have the same entity structure. They didn't have income streams coming from the same places. And they had different, some were interested in real estate, some weren't, some had, losses that they were able to harvest. So really just want to emphasize here that the tax strategies that are going to be best for you depend on you. So there are things that you can think about universally, but ultimately the best outcome is always going to be so personal. Does anyone have any questions so far?
So guys, if you want to unmute and ask, or you're welcome to drop the questions in the chat. I had a quick question for you, Rachel. What is an S election run? Or you said you run an S election?
Yeah, so an S election is it's a tax election to if you have a corporation or an LLC, those are different types of business. And an S corporation is a tax treatment. So an S election is something that you file that allows your business to be taxed as an S corporation.
I see.
And the S corporation is special in that, unlike a C corporation where you're subject to double tax, the corporation is going to pay tax, and then you're personally going to pay tax on any income that you receive from the corporation. So you're paying tax on income twice. With an S corporation, the company doesn't pay any tax, but you pay tax on all of the income that the company makes on your personal return. So it's a special kind of company that has a unique tax treatment that often is really beneficial for people, especially if you're in the service industry and you're living off the income that your business is making.
Okay. And then if you're a 1099 position and you're making over, what limit would you say? 100,000, 200,000?
100,000 is a general rule of thumb, but it's definitely impacted by other things going on in your tax situation, like whether or not you already have W-2 income, what state you're living in. So there are other factors that can affect your decision, but usually around that $100,000 mark is the time where you should at least be having those conversations and thinking about it.
Okay. And for someone who's fresh out of training, like we have Hannah on here, she's in a 1099 position. She said she's been handling her own taxes. She's calculating how much she needs to pay quarterly. She's handling it on her own right now because she has almost $500,000 in student loans, and she's planning to rent until those are paid off. Is there anything you would recommend for her to keep in mind with
I
student
think
loans and tax strategy?
Well, with student loans, you do, depending on how much you're making, you do want to focus on, there are certain income limits where as you make more, your ability to deduct student loan interest phases out. So it's important to think about, to know those limits, and if you have the ability um, to, if you're close to the limit, just prioritizing, maybe there are some more deductions that are available to you to help you
So
close and tall.
in certain loans, like the amount that you're paying back is determined by your income. And they're looking for your income to figure out how much you need to pay. Um, if you're getting everything as a 1099, your opportunity, it really depends if they're 1099 or W2, but if you're a 1099 and it can be optimized, you can present a lower net income, business income, when you're filing your taxes, of course, but then also to the company that basically gave you the loan. So they will demand less payments throughout the year in that case, because you have the kind of like the option to push it down more aggressively compared to just a W2. So that's something definitely to keep in mind. And if she's a 1099 and she's a physician, it means that she's making at least, I would guess, $250,000. That would be like the lower end from what we know. I would definitely recommend to work with a professional and not do it yourself. It's deductible, by the way, like because that in situations like that, because the business is the complication, the cost of professional is deductible on the business, and it can help you in general to probably to squeeze the most out of your situation. Um, I cannot emphasize enough. You're a physician, you're not a finance professional. Try to focus on what generates you more and more money rather than spending hours, and sometimes it's tens of hours to deal with it yourself. I'll give you even more example. I can probably do my own taxes. I have a complicated situation, and I'm a client of my own company, fully paying client. So I can do it myself. I know enough to do it myself. I just don't want to because I prefer to build a company and do what I actually love to do. So it's something that definitely we see a lot of physicians, especially physicians, because you're so used to do everything, like at least your own money yourself, and you don't have the same support system. Try to maximize your income, and your income potential will outgrow basically the cost of maintaining the whole thing. So that's something that definitely I would share with the new attendings.
Yep. Anna, any follow-up questions? I don't
I
know
have
if
a
she's still,
question.
yeah, yes,
Um,
please.
Hi,
Go ahead, Ryan.
I came in toward the beginning or toward when you were starting talking about donor advised funds. So I missed the beginning part of that. Um, how are you saying to use them for, like, I mean, versus a regular just giving a charitable donation?
Yeah, so if you have appreciated stock, donating the appreciated stock to a donor advised fund gives you a better advantage than if you were to sell that stock and contribute the cash to a charitable organization, because you don't pay tax on the gain, again, like appreciated stock. So it went up in value. If you sold it, you would pay tax on that gain. If you
Hmm.
contribute the stock, you don't pay tax on the gain, and you get a contribution for the value of the stock. So as if you had sold it for cash and contributed that cash. So it's like a double benefit that you get a higher charitable contribution and you don't have to pay capital gains tax on what appreciated. So if you're interested in charitable giving, it's definitely a really valuable tool.
And so like any company like Fidelity or whatever, any of those companies, like you could just open
Um,
or how does that
yeah,
work?
we have a couple of partners that we see our client. We have partners that we see that our clients love working with them. So there is Daffy, Fidelity, Charles Schwab. There are multiple of those. Um, it really depends what exactly you want to donate. You can donate stocks, but you can also donate. And this morning I had a call with like somebody, and it's about art, like donate like very fancy piece of art. So you can donate many types of assets. It really depends what you are looking to donate. But if you are looking for standard like stock donations,
Mhm.
um, Daffy.com, Daffy.com, Charles Schwab, all of those will be they will do the job. Let's put it that way.
Yeah. And an extra benefit is if you're in a really high income year, you can also use a donor advised fund to contribute like maybe 5 years worth of charitable giving. And then over the next 5 years, so you'll get the benefit up front. And then over the next 5 years, you can distribute that money to charities of your choice.
So
So you get the deduction when you contribute to the donor advised fund, and then at any point later you can actually give the money to the charity.
So that's actually a great point. I'll give you a practical example of what we're seeing people do. People like, let's say they donate to their synagogue or to the church or to the mosque, like whatever it is. Like they donate every year a certain amount. Sometimes it's on a monthly basis, sometimes quarterly, sometimes annually. And if they had a pretty high income year, what they are doing, they donate upfront in that income year. They get a deduction, so they push down their tax liability. If you get a sign up bonus, basically, if you start a new job, if you started like something happened and you got like a lump sum, let's say, you make the donation, you let everything to be invested in the donor advised fund, but every year you sell a little bit there and you basically make the donations to the institutions that you're looking for. So that's something that we see a lot of people utilizing that for.
Setting it up as a recurrent donation, but then selling it
Exactly.
only when needed
In
or
the high income year.
Exactly. Yep, exactly. So that's something that is very common. It can be also for kids, like if you have children, like for the kids like a soccer club or something like that. If they need some like the sports club, you can use it for all of that as well. In a lot of the cases.
Question for you guys. As far as like right now, we're in May of 2025, and let's say I want to start a DAF, but I decide that in December. Can I still do that in December and it counts for 2025 accounting?
Yeah.
Is there a time I need to decide by?
You would need to have the donor advised fund set up before you make the contribution, and then you would need to make the contribution before the end of the year. So you get credit when you make the contribution. So if you want to, whatever year you want that to apply to, if you make it on January 1st, you can't get credit for it in the prior year.
Something to keep in mind, a couple of things to keep in mind. It takes time sometimes to open the donor advised fund, so it's better to do it like earlier rather than at the last minute. Number two, sometimes when you are making the donation itself, from the moment that you decide, okay, I start the transaction from my brokerage account until it reaches the donor advised fund, it can take time. It can take sometimes multiple days. And in that time, it might, so it really depends on the provider, how much time it takes, that it's up to them. But we had cases that it took a couple of weeks, for example. So you want to start it earlier rather than later, or you can do it you want to make sure that the account is fully set up and you can make the donations not at really the last day, because it might not reach the account in the last day of the year, and then they will not give you the receipts that they need to give you in order to claim the tax benefit. So please do not wait until like December 31st to do it. It's better to do it if you want to, you can do it in December, better in the first half of the month and not on the second half of the month. Holidays, everything is all together. Sometimes they're a bit slower also to process those kind of requests. Be very cautious about that.
How long does it take to set up a DAF? Like how many months or weeks should we give our?
Oh no, you can do it in probably a couple of days, but it depends on the provider. It depends who you choose. It depends if they have any KYC. It's something that it really depends on the provider. It's not something that we can guarantee people. Let's put it that way. Yeah, Rachel, you can take it from here.
Okay. So I just want to call out that, the strategies that applied here weren't the only strategies that we looked at. So there are there are hundreds of strategies that are available, but this is just an example of some other strategies that we considered, but we ended up not moving forward with, either because it wasn't available, or it just didn't fit into the customer's interest. So for example, changing your state of residency, if you're in a high income state, you can save a lot of tax that way, but you do need to move to a new state. So especially if you have a W-2 job, that could mean you need to change where your income is sourced. You're really uprooting your entire life. So if you want to have the tax savings, that's great, but it is a life decision. You can't just change your residency on paper. Things like real estate professional status, it is a lot of work, and some of these things do require heavy investment in order to get the tax benefits. So just keeping in mind and emphasizing again that really what you're interested in and what your goals are for your entire financial picture are really important in speaking to what strategies are going to be relevant for you, and where you're going to be able to really maximize your wealth across the board. And then, Tal, do you want to take it away?
Yeah, so just to summarize everything, there is no one size fits all tax strategy. Each person has their own preferences, their own unique income sources, and how they make money, and how much money they make. So each basically situation requires its own plan. And so there is no a one playbook that everybody should implement altogether. Another thing, even with the donations, it's you get a deduction. A deduction is not like you get if you donate $10, you're getting $10. It really depends. There is a very big difference between deduction and credit. Deduction is you're saving the tax rate that you're in, and a credit, you'll actually save dollar amounts depending on the amount itself. So deductions still cost you money. It's still meaning that you're going to give away money. The question is how much, and that's what deductions, by the way, help with. The entity structure and the total, like the total income matters. Like that's something that you should definitely optimize with your tax professional. I would not recommend to do it yourself. The difference can be tens of thousands of dollars in additional or less, more or less taxes. And there is also like the question of audit risks and maintenance for those entities. It's expensive to have multiple legal entities. So it's not something that you want to take lightly. And when somebody is telling you you should do that, always also ask why and what's the alternative. Because it's going to cost you money, so you want to make sure that there is a reasonable ROI for any complication that you're creating with your tax situation. And for sure, I think that physicians are one of the populations that are definitely under optimized due to the just like the line of work. You're working extremely hard. You have a very high stake job. It takes a lot from you, like just to do the job well. It's very complicated. So we do see that like people have less time to invest in their finances, and it's something that we see definitely that physicians overall can benefit from a better tax strategy and a plan. And the last thing is don't do something like one big thing. Do it in steps. Like you don't like a lot of the times taking it step by step. It's just like easier to get acquainted with the situation rather than doing like a huge change right away. But I think that those would be the key takeaways from this conversation.
Wonderful. Thank you, guys. That was so informative. Guys, if you have questions, feel free to unmute, ask away, put them in the chat if you're not able to. I will ask a question, something we didn't talk about today. Could we talk about like the home office deduction and the Augusta law or rule, and if you can take both?
We don't have that much time left, but it's basically if you're a business and in certain states, even if you're not a business. So there are also, it's not just about the home office deduction. For example, if you're living in California, I think that we had one physician in California, and usually you're required to work from the office, but in certain cases you're also working from home. And in certain cases, especially if you're a radiologist, for example, your main place of business might not be the office. You might work remotely. You can take home office deduction from your as a W-2 even from the state, or yes, from the state of California. But it really depends on the situation, not relevant to everybody. But there is also state level deductions there. Even if you're a business and you are working from home and that's your main place of business, you're starting to have a choice. How do you account for the usage of your home for your business? And the home office deduction is one of them. Augusta rule is the other. You cannot take both of them. Both of them are very different, but I don't think that you have enough time, at least for it right now, to open up those topics. But again, talk to your tax professionals, work with them in order to make sure that you maximize those deductions as much as possible.
Wonderful. And if folks want to work with you, can you share more information about how they can reach you and the Trifecta MD special too?
Yes, Asaf, are you here? That's not sure if Asaf is here, but yes, we have we will publish a link and we'll send it through you, Dr. Samra. And and when somebody will get on a call with us through that link, we'll make sure that they are getting basically also the promotion for the group.
Okay. Wonderful. Thank you. And it looks like there's two quick questions. Well, I don't know if one of them is quick. Is the home office deduction available even for W-2 employees?
So in certain states, yes.
Okay.
It's on the state levels, and it really
So in
depends what you
California?
do. In certain California is one of them, but
Okay.
again, it depends what you do and what type of physician you are. It's not available for all types of physicians. It depends on your arrangement with your workplace. But in
And
certain cases, you can do. New York is another one, by the way. So the high tax states, sometimes they give you a little bit of, a small treat for all the taxes that they charge you. So they give you a little bit sometimes there.
Okay. And then Radhika is asking, what states are best to purchase short-term rentals?
It depends on your ROI. California tends not to be the best because they have a lot of problems in California and real estate. So all the states usually, if you have a good deal, get a good deal unrelated to the taxes, because first and foremost, you want to see the ROI. If you put $300,000, what you're getting in return for the short-term rental. So that's the number one thing that you want to consider across all states. But exactly, California, I would say that the only state that I would personally, not an investment advice, of course, but I would personally avoid from purchasing real estate if I could is California. A lot of limitations. Investment properties, of course, a lot of limitations. Very, yeah, and as somebody wrote there, like it's very tenant friendly, not necessarily landlord friendly. We're happy with Chicago. We have a lot of clients purchasing real estate in Texas. North Carolina is a pretty popular one, but pretty much all over the country. It's just with California, you have a lot of laws that limit what you can and cannot do with certain strategies about real estate. So that's the main place that I would be a bit cautious with.
Very good. Well, wonderful. If there are no other questions, all right. So did you want to put, so Asaf has shared a podcast with us, and it's about the pros and cons of electing an S corp. And so, Hannah, I know you were asking about this, so I definitely take a listen to this podcast. And then, if there's other useful links, definitely feel free to share them with us, and we can further share them with our community. And then, the best way, and then there's also Gelt has a special offer with Daffy right now if you want to create a donor advised fund. And so you guys are going to share more details with us, how to get in touch with you and all of that. So this will go out with the replay.
Awesome.
We'll share all the resources.
Wonderful. Well, thank you guys. Thank you,
Thank you.
Tal. Thank you, Asaf. Thank you, Rachel. Rachel, I look forward to chatting with you soon. As I shared in the beginning, guys, Gelt is who I personally use and hence have brought them here to you guys. I'd highly recommend doing a like a consult call, Tal. Do you guys do that? You do, right?
It's not an official advice or anything, but it's usually the discovery call with
Yeah.
Spencer from our team.
I'd highly recommend doing that. I mean, I found that call to be extremely valuable. And of course, it led me to signing up with them. And there's nothing like a personal example. So, and if you guys have any questions, feel free to reach out to me directly as well. Thank you all for joining. Thank you to Gelt for your time.
Thank you.
All right. Take care, guys.